Hey everyone, welcome back to where I share tips, advice, and insights to help you navigate the world of real estate. Today, I'm diving into a topic that's a little bit different, but definitely worth understanding. Whether you're a homeowner, investor, or just curious about how changes could affect your financial future, let's get into it. So, let's break it down. First, let's talk about unrealized capital gains. What does that mean? Well, think of it this way. If you own an asset like a house or a stock or a piece of land and the value goes up, that's a gain. But until you sell it and cash out, that's an unrealized gain. It's what we call a paper gain because it's not in your pocket yet. For example, if you bought a house for $200,000 and now it's worth $250,000, you have a $50,000 unrealized gain. But unless you sell that house, you haven't realized that profit yet. Now, under the current tax laws, you only pay taxes on these gains when you actually sell the asset. That's when it becomes a realized gain. But here's where the proposed unrealized capital gains tax comes in. The current administration has proposed a tax that would apply to the growth and value of these assets, even if they haven't been sold. But here's the kicker. This tax is only aimed at people with over 100 million in assets. In other words, we're talking about the ultra wealthy, these in the top 1% of Americans. Why target these people? The idea is that many of the ultra wealthy grow their fortunes by holding on to assets that increase in value, and they don't sell them until they need to. This allows them to avoid paying taxes for years, sometimes decades. By taxing these unrealized gains, the government could generate additional revenue and address the growing wealth gap. How would this work? Let's say, for someone with 200 million in assets, if those assets grow by 10 million in a year, even if they don't sell, they owe taxes on that 10 million gain. This is very different from how taxes work now, where no tax will be owed until the asset is sold. Now, let's talk about how this affects the middle class, you and me. The good news is that it doesn't. The proposed tax is designed to hit only those with over 100 million in wealth. So if your house goes up in value or your investments grow, you won't be taxed on those gains unless your net worth is in the hundreds of millions. So for the majority of us, it's not really a common situation. But here are some concerns that are ruffling feathers. Some critics are arguing that while the tax is aimed at the ultra wealthy now, it could set a precedent for future changes that might affect smaller investors and business owners down the road. There are concerns that taxing unrealized gains could deter long-term investors, potentially impacting economic growth. So unless your net worth is 100 million, this tax won't apply to you. The big takeaway here is that for most Americans, especially middle-class homeowners and investors, this tax won't have any immediate impact. It's aimed at the wealthiest in the country to ensure they contribute more in taxes. But it's definitely worth keeping an eye out on how these proposals evolve because future changes could shift the tax landscape in unexpected ways. All right, that's all for today. I hope this gave you a better understanding of what the unrealized capital gains tax is all about. As always, I'm here to help you stay informed on anything that could impact our real estate industry. Thanks for tuning in, and I'll catch you on the next episode.